Hi everybody, this is Gil, and it is Wednesday afternoon, 3:14 p.m. Pacific time, and I wanted to do this review of this morning's intraday live webinar that Dr. K and I did. For those of you who were able to attend, for those of you who are not able to attend, we have this synopsis of what was discussed in the webinar, which we think there were some important points to be made, and some of those actually played out into the close, believe it or not, despite the sloppy close. So I'm going to go through what we see by the end of the day, which changed a little bit from what things were looking like during the live webinar, which started at 10:30 a.m. Pacific time, which would be 1:30 p.m. Eastern time, and 6:30 p.m. London time, where Dr. K was coming in from live this morning. But in any case, I think the market action was pretty sloppy, and one of the things that, of course, doesn't work in the market's favor is you see this pickup in volume for 3 days as we come down off the peak. This was a down day on Monday, despite the fact that we filled the gap and closed at the top of the range. And you'll see that it is color-coded to coincide with a down day. Sometimes I like to show it blue if it opens and then closes higher than it opened. So this would actually be blue on that basis, but we made this red for those of you who have trouble with the other color coding that we like to use. But in any case, you come down 3 days, volume picking up, heavy volume. Today you try to rally, volume was tepid, which in and of itself not necessarily a problem. After hours, you see the futures down on news that the U.S. debt might be downgraded to AA, little a, I don't know. I saw some weird letter rating that they were showing, AA, small a, or something like that. In any case, we can see that the market comes off and closes near the lows of the day on very weak volume. So very sloppy, very mushy. It may mean that you're going to come in and pull down and test the 50-day moving average. But what we have observed this morning during the live webinar, about midday, a little after midday, is that the stocks for the most part were not all that impressive. There are a couple names acting reasonably interesting, and we'll get to those in a second, but for the most part, most things were just kind of dead in the water. You know, things were trying to move higher, and if we take a look, let's take a look at this chart here, just a daily chart. I'm going to run through some names. For example, you see Netflix here. It tried to get through the 300 level and wasn't able to do so, and it backed off a little bit. That's not really a big deal, but you know, a little bit sluggish. You would have thought if today was such a hot day, it would have powered through 300, invoking the Livermore century mark rule, whereby stocks going through a round number, 100, 200, or 300, should continue higher very strongly. You saw Baidu coming up the right side. Yeah, it's coming up the right side and backing and filling here. It could do that for a period of time, or it could head back down to the lows. But nothing truly exceptional or exciting. You know, Apple sitting here at the top of this big, ugly range, trying to go higher, doesn't really get anywhere. In stocks like VMware, which recently broke out through the 100 level, it's kind of sitting on top, not really going anywhere, just kind of sloppy. Salesforce is another name that looked kind of interesting, coming up off the lows, and it's backing. And to some extent, you could say they're entitled to these pullbacks, and maybe it's not that big of a deal. But for our money, we like LinkedIn much better than anything else you're seeing out there, because it did continue higher today on a pocket pivot volume signature. Now this is a volume signature, not a volume or pocket pivot buy point, okay? Because you're well extended for the 10-day moving average at 95.86. However, if you bought on this pocket pivot that we alerted you all to on Friday of last week, which came roughly off the 10-day, you know, close enough for horseshoes and hand grenades for us to call this a pocket pivot. Also, it's a breakout from a cup with a 3-day handle, which reminds us of the dot-com stocks back in 1999, where things would form these 1 or 2 or 3-day handles and then just launch higher. And LinkedIn and the whole social networking thing has that feel to it. So you went higher today on a pocket pivot volume signature. Now we have a cup with a one-day handle. It's going higher again. I don't think I'd be buying this. However, what we can do is use a violation of the 10-day moving average at 95.86 as a stop out level. Now, if you're losing sleep and you have some gains in LinkedIn and you're losing sleep about losing your 10% of gains or so, maybe a little less, maybe a little more, depending on where you entered, then maybe you chicken out and you sell into this if the market gets weak. On the other hand, sometimes stocks that are exceptional situations, rare situations, they can continue higher even if the market slushes around. Now, if the market starts to break down, it's possible LinkedIn could get dragged in towards the 10-day moving average, but that would be, if we took any position here, that would be our stop if you want to give yourself the chance to be right. Okay, if you want to chicken out, well, then that's your business. Take your profit, your little profit, and move along. You can do that. Or you could play a smaller position if you wanted to and just give it a chance. Who knows? Maybe it goes higher. But there's always this potential for QE3 to come in some weird form into the market. And so our guess is that at best maybe stocks are choppy on a broad basis, while there may be individual opportunities in certain stocks. We were a little disappointed today. We had a couple of pocket pivots that started out looking good today. This is still a pocket pivot because it closed up, but you notice it did give up a lot of its gains on the day, which is not as constructive as you would like to see on the Dish Network Corp, DISH. Another one that we were looking at was Fusion IO, FIO, and this was looking nice today. Definitely a pocket pivot volume signature. Now it did close out, but it's not a pocket pivot because it closed below the 10-day moving average. So that's a little bit disappointing. However, the stock's kind of in a flag formation. You have this little shakeout in here. So maybe this would be a stop, $29.95 I think or so. Basically the 30 level plus a little bit, a nickel or a dime or two, I don't know. Depends on your risk tolerance if you were buying this. Or you could just use a 10-day as a quick stop out if it doesn't work. And in some cases that is the best way to go because it may just have to issue another pocket pivot. So the bottom line for us today is that we weren't seeing any exciting action in individual stocks even when the market was rallying higher and pushing 90, 100 points on the Dow earlier this morning. And so to us that's a little bit dicey. We have to wonder whether QE3 will simply become the big bid to hit. Now that said, the market direction model did swing into a buy signal this morning. It's possible that it could be changed back to a neutral or even a sell. And the one thing to remember, and this is a big point we made in today's webinar earlier today, is that the market direction model will have a lot of quick buy and sell, neutral, all these false signals. It can have a series of those in a row or very near to each other in a short period of time. And the reason for this is because of the fail-safe aspect of the model. And this is something Dr. K came up with when he studied timing models being implemented by a lot of different people out there. The one thing is this sort of lock and load type of signal that they get, where they get into a signal and it's very hard for them to get out of it before they get creamed. Or they will sit locked into a signal because the criterion that they use to generate that signal are staying aligned, but the market is doing something entirely different. And so there are fail-safes in Dr. K's model, which I think really is the strength of the model, is that you're going to get a lot of tiny losses potentially before you catch a large trend. And if you're in a choppy, slushy environment, then when you get a buy signal, maybe you don't come in as heavy. You work your way in, and you have to do that according to your own parameters. So really the high probability play, or the highest probability play that we see right now, is the movement in the precious metals. And of course that implies silver, which had a pocket pivot buy point. We talked about this yesterday when the GLD or gold was breaking out to new highs. Now the one thing I would note today on gold is it just has a little bit of this abandoned baby, but you could have said that here where it gaps out and it closes mid-range. So it's possible it could back and fill. I mean, it's had a heck of a run, up 1, 2, 3, 4, 5, 6, 7 days in a row and breaking out to new highs. So it's entitled to a pullback, which might take you down to the top of this, somewhere around 151. I would use either one of two levels if you really want to play it tight, but you got to remember this might imply that you're going to get shaken out pretty quickly. You could use the top of the breakout somewhere about 150 up to 151. Or you could just use the 50-day moving average at 148.34. That's the way you could handle that. With the SLV, this is pretty clear here. You had a pocket pivot yesterday. It's nice to see all my friends are coming online on Skype right as I'm doing this video today. But that's the law of Murphy, otherwise known as Murphy's Law. But in any case, you have silver gapping up on a pocket pivot move above the 50-day moving average. Yesterday, this would have been viable based on the breakout in gold. Remember that we're correlating the two. We think that the two will tend to move together, so that given the fact that the SLV is so far down in its pattern, what you can do is you can use the movement in the GLD as giving you a buy signal yesterday on the SLV, and you would expect the two to correlate. And in fact, the SLV correlated a lot better than we might have expected when it was up over 5% today. Well, gold was up a little over 1%. So you got a lot more juice on the SLV today, but that's been our thinking because it tends to be 2 to 3 times more volatile than gold, and today it was moving a lot more sharply. Now, we would have liked to have seen maybe above average volume here, but it was definitely pocket pivot volume action, and so that's a clean pocket pivot. Now your stop here is 35.16. It's going to take you about 7-8% down, closer to 7% down from here. So that's a reasonable stop, and you can start pyramiding position. Now today we talked about pyramiding positions, and one technique that we would use would be a very simple one, and I want to remind you all that pyramiding techniques or pyramiding algorithms are really a function of what you want to do to handle the position. So you have to assess how much risk you're willing to take, how heavy you ultimately want to get into the position. There is no one-size-fits-all magic pyramiding technique that ensures that you will pyramid at all the perfect spots and never lose money or never be underwater on any portion of your position right after you add it to it, okay? You have to just do it in a way that allows you to pyramid logically, and that also gives you downside stops that will be following along with the stock price. That's why we use the 50-day and the 10-day, because they generally will tend to follow behind the stock or the ETF price, and therefore they usually provide constructive areas to use as selling guides. Sometimes pullbacks to the 10-day or the 50-day can also be areas where you could add if you're using a particular type of pyramiding scheme that does that, okay? And that really depends on what you want to do. But I'll give you an example of something that we have used in the past, and that is you buy a position, say in the SLV here. So let's say that you buy a 20% position and you have a $170,000 account, and so you bought at 35 and you bought 2,000 shares here. So what we would do is when it's up 5%, we would buy another 2,000 shares. Now that's going to be 5% more than you bought as a percentage of your capital, because the price is higher when you buy the same amount of shares, right? So you buy 2,000 at 35, and then you buy, and that's going to be about $70,000, and then you buy 2,000 at 37.23, and that's going to be close to 460 shares, something like that. But you get the idea. So what's going to be happening is you actually are adding more shares on a dollar basis, or more on a dollar basis, not more shares. You're adding the exact same amount of shares, but you're adding more money each time. So some people get concerned that maybe you're getting top heavy. We wouldn't be so concerned about it, because 5% more is really not that much. And the thing is, if you get a real accelerating move in something like we did in the AGQ, it really gets going. By the time you're here, you have a big position, and this thing really makes you a lot of money on this last blow to the top. And of course, that was a climax top. But that's essentially the type of algorithm we use on the way up. And again, there's no magic answer here. You know, everybody wants to deal with certainty in the stock market where there can be no certainty. So it's either it's a fruitless endeavor. All you can do is put yourself in the position to be right, using proper risk management techniques and using proper pyramiding techniques that are logical, that are consistent, and that don't get you into a lot of trouble. So we would be watching for the 10-day moving average, 50-day moving average to provide support on the silver, but we would actually key it closer to gold. In other words, if we got stopped out of gold, then we might consider stopping ourselves out of silver as well, since you could have bought yesterday on just the basis of gold going higher. And I see after hours the precious metals are up a little bit more on the ETFs, not a huge amount, but they're acting well. But they could pull back. You could even see silver pull back into the 50-day moving average short term. Remember, it's going to be volatile, but you do have your buy point, you have your reference point in the 50-day moving average on the downside. That's basically what we're looking at. You know, the miners, people ask about the miners. Nice gap up here in AG, which was a hot new issue, I believe, or at least one that was a cheap gold stock, has come up, First Majestic Silver, and it made this big base ever having a sharp run, which was climactic, as you can see, and then it topped out and makes this double bottom, and now it's coming up the right side, and you maybe have a breakout point here. I guess if you wanted to mess around with the mining stocks, you could. We prefer the pure play in the SLD and the GLD. And that's pretty much what we discussed today. We're talking about some of the stocks that looked good, but for the most part, we don't see a lot of stocks in viable positions, and the pocket pivots that we discussed today, as well as some of the others, like the Click Technologies pocket pivot here, not really a problem. It hasn't broken the low of the pocket pivot day, but that's not really what you want to see. You'd want to see more power. There's other one was Ulta Salon Cosmetics, same thing here. Didn't really violate that low of that pocket pivot day, but that's just kind of sluggish and tired action. You see the leaders like Amazon just kind of sluggish. I think Lulu, they split, so they were acting well, but again, tried to go higher and closes at the low of the range. Just sluggish action. So really, where's your real juice? What closed the best today? Actually, silver, because the GLD stalled a little bit. And you can see here, you got that a little bit. That's not necessarily a problem, but it wasn't as powerful as silver. So silver probably the most powerful thing out there for us today of the things we've been talking about. Of course, we were all over this yesterday on the Pocket Pivot Review emails. So that's it. That's pretty much covers what we talked about today. We do think stocks are slushy, but the precious metals are acting well. After hours, the U.S. Getting tagged with talk about potential debt rating downgrade. To some extent, it's like a big deal. We already know that the U.S. should probably be single A anyways, and that would be a good thing for most people because it would keep them from borrowing if their credit rating was downgraded. But here we have to pretend that the U.S. is a sterling AAA, and that it should just continue borrowing itself into oblivion. Given that, we think that precious metals have that appeal as an alternative currency of choice, as well as being candidates for a safety trade into gold and silver if the global financial system gets into trouble. Now, the one thing to keep in mind is that if the stock market continues lower and the selling begins to get exacerbated, then precious metals may likely suffer some pressure, but we would watch how they act on any pullback given the stop out levels and the support levels that we now have working in our favor at the 50-day and at the top of the breakout on the GLD. All right, that's it for now. We'll catch you guys next time. Have a great rest of the week.